Hello, everyone. Thank you for joining me today. My name is Ryan Woolhiser, and I'm the Portfolio Manager and CIO of our Capital Solutions Group. As we know, presidential elections can create uncertainty in the financial markets. Today, we'll explore how different presidencies have impacted market performance historically and what lessons we can take away from these trends to share with our clients. We will start with this chart that shows the historical market performance under various presidents since John F. Kennedy in 1961. The S&P 500 posted negative returns under only two presidents, Richard Nixon and George W. Bush. The biggest market growth occurred during Clinton, Reagan, and Obama. Overall, the market has consistently grown, showing that regardless of who is in office, staying invested historically tends to pay off in the long term. Moving to the impact of political parties on investments. Some investors may consider changing their investment strategy based on which political party is in power. However, data shows that making investment decisions based on party alignment often leads to lower returns. Since 1950, investing only during Democratic presidencies yielded an annualized return of 5.2%, and only during Republican presidencies yielded 2.78%. However, staying invested throughout all presidencies led to an annualized return of 8.13%. While past performance does not guarantee future results, this highlights the importance of long-term consistency rather than short-term political changes. We will now take a look at investor anxiety and market volatility. Presidential election years often are accompanied by increased market volatility, especially leading up to the election day. The CPWA Volatility Index shows heightened anxiety during the final months of campaigns, but this often settles once the election results are finalized and we head towards Inauguration Day. It's important to remember that temporary uncertainty doesn't usually justify drastic changes in investment strategy, leading us to the importance of a long-term strategy. Investors sometimes worry about market performance during election years and move their investments to cash. However, pulling out during election years has historically led to underperformance. The annualized return for remaining fully invested since 1950 was 8.13%, compared to just 6.32% if investments were moved to cash during election years. The key takeaway here is to remain invested and avoid short-term reactions based upon election outcomes. The next two slides, we will take a look at the market reaction to incumbents and market reaction to incumbents and challengers. The market tends to react differently depending on whether the incumbent or a challenger wins the presidency. Historically, Democratic incumbents have led to the highest post-election gains in the S&P 500 between Election Day and Inauguration Day. However, the overall trend has been positive regardless of which candidate has won the election, showing that historically the market has valued stability once the uncertainty is resolved. In conclusion, while elections often create some market volatility, the overall message for investors is clear. The data suggests that staying invested during these times has been a good approach. Making decisions based upon party alignment or short-term volatility has the potential to be detrimental to long-term growth. We believe it is critical for us to emphasize patience and a long-term focus to our clients during election cycles. Thank you for your attention today. I hope this gives you some useful insights to guide you through any election-related questions. Feel free to reach out with any questions.